for that, Sharad. Let's connect with Hemang Jani, who's joining in on the show. Hemang, let's assess the market because it seems like the exit polls had it way off the mark and investors clearly suffering on account of that with a 6% carnage on the frontline index yesterday. Broader markets had it far worse. What exactly would be the prudent approach now?
No doubt, there was a bit of a shocker the way the election final results came out. But the market would probably come to terms with it. I think sometimes there is always a knee-jerk reaction because of the high, agenda narrative that is being built. But the outcome is not necessarily bad for the country and market. That's how I look at it. I think people would be comfortable once there is a clarity on finally the BJP and Mr. Modi becomes the prime minister with the support of some of the allies, and the focus will shift to who becomes the finance minister and the other important portfolios. So I think though we may see a little bit of volatility here and there, by and large, a large part of the damage has already been done. I think we are undermining what actually happened yesterday. Many stocks were down anywhere from 10 to 25%. So I think there is not much of a scope for incremental damage except for the sector rotation which may come through. So my feel is that it's time to kind of look at the current holding that investors would have and try to make some changes to bring in slightly better quality stocks other than narrative stocks where the numbers are good, where the valuation comfort is there, and surely it will give a decent return.
Okay. What about the valuation support that we're seeing in private banks? Is that something that you would look at when assessing the entire private banking space?
Oh, absolutely. I think if you see banks as a whole has underperformed the Nifty by a wide margin, and within the banks, the private sector banks have underperformed PSU because, as we all have seen, last 1.5 years, it was all about PSU bank, the smaller bank. So that I think is surely going to change. So I think it makes more sense to go with a larger component of the private sector banks, be it ICICI or Axis. It would be prudent to have some SBI in the portfolio, but the smaller PSU banks is something that I would not be comfortable owning up.
Okay. I just want to go back to that graphic which we used as a short-term graphic, which is that what will change for the market in the short term? See, there are three basic questions you would ask yourself. Between yesterday and today, the exuberance, the euphoria, the excitement, this entire risk-off moment, buy today, sell tomorrow, buy in the morning, sell higher, all that excitement which got built up, that has reversed. Second, it's not that VIX is going to remain permanent here. See, a lot will now start settling down. The cabinet formation, 100-year Modi agenda, how the Modi government would be focusing on. If there is any indication to be focused on, look at Prime Minister's address to the nation last evening. In that short address, he was focusing on words, he was focusing on reform. He used the word semiconductor, labor reforms, which means one would imagine that progressively the direction may not change. You may start seeing outperformance in defense, so where P multiples will not contract now. Defense, pharma, FMCG, P multiples will not contract there. And private banks, I think, will find buyers at lower level. That's what I think. PSU banks, you can argue. However, there are a lot of policy-related stocks which I've been maintaining before the election cycle. And after the election cycle, they'd become obese. They'd become, if I may use the word, Humpty Dumpty. They'd become Humpty Dumpty. And Humpty Dumpty's had a great fall. Now, that is somewhere where you will have to see time-wise correction. You can see more price-wise correction. But I don't think institutional investors or DI investors or HNI investors coming back in a hurry to buy themes like defense or policy-related stocks. Power, yes. Defense, no. Railways, mixed. But in terms of a lot of capex-dominated themes, I think they will take a pause. Hemang, how much of your portfolio you would reorient, move back to defensives, as percentage?
It depends upon the current composition of the portfolio, but incrementally, I would surely increase the weight for some of the private banks, pharma companies, to some extent, commodities, because we are seeing globally the data points are encouraging in terms of China, in terms of Eurozone, US. So I think commodity as a space should do better. A little bit of IT, maybe there is not too much of an excitement. It could be more of a tactical play, but surely some of the IT names would feature there. And FMCG, I think, is more like a tactical play because you've seen a major sell-off across the PSUs and the narrative stocks that we call. So that money has moved to FMCG, but whether FMCG by itself will give you exciting returns and growth, that I'm not too sure about. But if we have a good monsoon and if the data points are indicating that there is a growth, surely FMCG would feature in that portfolio.
Kunal, buy defensives, but don't quit the market. Is that a good idea?
Yeah, I think you have to have some tilt, towards defensives in this kind of a market. So, Nikuj, I think it's a matter of, initial in this kind of a sharp carnage after yesterday. It's a matter of first trying to decipher which are the next set of patterns in terms of sectors which could lead the markets higher or those particular sectors or stocks higher. But I think on that sense, what we look out for is that which are the sectors which are shielding from this major market volatility. And I think after yesterday's price up move, and not just yesterday, but I think as a cluster over the last 1 month, we've seen many of the FMCG stocks making a very strong comeback. Yesterday was just a day because it was highlighted quite strongly because of the outperformance these stocks showed with respect to most of the stocks. So I think in that sense, the outperformance could be a lot more stark. But then when you look at this over the pattern over the last 3 weeks, 4 weeks, 1 month and so, I would believe many of the stocks are coming back to their prime in terms of a breakout. So I think whether it's HUL, which is just yesterday made a comeback towards a breakout of 200 DMA, Godrej Consumers coming back towards the previous swing highs about the 1300 mark, Britannia making a strong comeback for itself, Tata Consumers, a stock which has been beaten down significantly over the last 2-3 years, yesterday for the first time showed a strong price volume reversal, which could potentially lead to a major bottom formation for the stock. So when we look at these kind of patterns, because it's synchronized in nature for most of the FMCG stocks, we probably sense that this could be a trend in the making for the sector.
Hemang, what's the advice on the Adani group of stocks? In trade yesterday, the market cap erosion was about 3.6 lakh crores. Is it advisable as of now to just steer clear?
For the election results, we have seen a major spike and the stocks have done very well. So obviously, because of the election, results, there was some sort of a knee-jerk reaction. I think you may see a bit of a correction there, but I think select stocks will present great opportunity because if the NDA forms power with Mr. Modi at the helm of that, then I don't see any reason why some of these stocks will go through an extended correction. So I think Adani Port, surely would present a great opportunity, and to some extent even Adani Enterprise, because at the end of the day, the focus of the government will remain on the infra play, the solar, the green energy. I don't think that is going away. So from that perspective, for those investors who have a slightly high risk appetite, should surely look at getting into Adani Ports and some of the other names within Adani Group.
Fair point.
Okay, fair enough. That's the view coming in on the entire Adani group of stocks. And what about the very favored PSUs, at least in the run-up over the last few months that we've seen? There's been a lot of fervor within this entire space. Hemang, does one just sit tight?
One, I think a large part of the re-rating story and the narrative around the PSU has played out. The market needed an event to kind of correct itself so that people take a reality check on what is the actual growth versus valuations for some of these narrative stocks. So I would certainly stay away from some of these names. Be it maybe defense should surely not have too much of a repercussion, but at least the P compression could surely be there. But the railways, the typical commodity stocks which are part of PSU, which have got re-rated for no real incremental fundamental reason. So I would certainly look out for booking out from some of the PSU names and move that money into some of the Nifty oriented companies, be it banks, certain commodities, autos, so on and so forth.